All right, diving in. So notes payable versus bonds payable. Well, the accounting treatment here is going to be pretty similar. We're really going to deal with much more on bonds, as I'm sure you've heard, right? This is going to be a much more heavier section on the exam. Notes payable, similar treatment if it asks for them, but mostly these will be bond questions. They're going to be valued at present value, their future interest and principal cash flows. Now, this is what you are going to be seeing, right? You hear about these present value factors and factoring and using those terminologies, and that's where people get intimidated, and that's fine. We will go through that and demystify all the issues you might see here. And then the company amortizes any discount premium over the life of the note. These 2 points we see here, they might seem pretty small, and you might be saying, what the heck is this? And that's fine. By the end of this, you'll know what is going on here. But this is really all of what we need to do for bonds. It's deal with discounts and premiums and discount. Now, I'm going to take this time to demystify a little bit more about the present value factors. Now's a good time. Let's go for it. So if you see present value of $1, that I want you to get memorized in your mind. That's for lump sum payments. If you see present value of, ordinary annuity, then that's going to be equal annual payments. If you see present value of annuity due, that as well is going to be equal annual payments, except that's going to be at the beginning of the year. What does all this mean? I will explain it. Just want you to memorize this. So that's the end of year. Now, all of these factors, what is the point of this? Now, you could do these bonds payable questions without factoring anything. This process of assigning a factor, this is accounting for time value money. Money is worth more today than it is tomorrow, right? You can use that money to pay off debt. You can use that money to invest and earn interest or investment income on. So that's why we're going to factor these. To sum it up, basically, we've got, let's say, a bond worth $800,000, but you're going to factor it by, let's say, 0.97. I'm making this up. The factors will never have to ourselves. Those are going to be determined by actuaries. Those, in the real world, these are actuaries. That's their job, is to determine these factors based on, many economic factors. These will always be given on the exam. Your trick here is determining which one to use. So this is basically saying that, okay, your $800,000 bond, remember, money is worth, I'd rather have $1 today than $1 tomorrow, because I can use that $1 today to pay down debt, which means less interest for me. I can use that money to invest, which means it grows more for me. So tomorrow, or maybe in a year, this $800,000 is going to be worth $776,000. You see there? So in reality, yes, it still is $800,000, but it has the buying power of 776. Think of inflation. Think of like, what's the buying power of your money rather than the actual value. Like, this is the stated value of your money. That is going to be the present value of $1. See, that's a lump sum. So if I'm going to pay you back $800,000 in, let's say, 2 years, we will use the factor of the present value of $1. Now, let's say we want to factor $50,000 interest payments per year, let's say for 5 years. They'll give you the ordinary annuity factor. And that might be, so if it's for 5 years, it might be like 4.5. So basically what that is saying, so normally you would just do 50,000 times 5 years. And that would give you your real, I'll call it a real value, right? Like what's really happening. And you've got your present value factor. So the present value one's going to be 225, and this one's going to be 250. Now, what this is saying is that because of the present value factor, and I've just thrown these numbers out there, they'll actually be given to you on the chart or in the information provided, you're basically losing $25,000 of value in your money over this 5-year period. Now, for the person borrowing the money, that's great because you're getting the cash today to use it on something, and you are giving up your less valuable money in the future. So ordinary annuity versus annuity due, if the question says, the payments are due at the beginning of the year, well, why is that important, the beginning of the year versus the end of the year? Well, the whole point here is time value money, right? Money is worth more today than it is tomorrow. So if we have a whole year of difference, right, and we're paying at the beginning of the year as compared to the end of the year, that's a whole year of different, of time for money to accumulate, for it to grow or compound. So if the question says interest payments are due at the beginning of the year, we use annuity due. If it doesn't say anything, or if it says end of the year, it's ordinary annuity. So default is ordinary annuity. It might not say. Some questions just don't say. In that case, I would use ordinary annuity.